Greetings. I'm John Butler, Investment Director at Southbank Investment Research, and I'm joined today by forensic accounting expert Bob Lyddon. Bob had a career in the City of London and worked at a major accounting firm specializing in financial institutions and the way they go about measuring, or as Bob may argue, mismeasuring their regulatory capital, among other aspects of their financial things that should characterize their financial well-being or not well-being. He's worked independently in recent years, and his work, quite recently, was featured in the UK press, in particular, just how the euro area financial system might be potentially grossly mismeasuring their regulatory capital ratios and the potential dangers that that poses, not just for the banks, but for countries themselves. So, welcome, Bob.
Welcome. Hi. Thanks, John. Thanks very much.
So, if you could please elaborate on this article that was, I believe it was in the UK Express newspaper, but one that went into some detail regarding this study that you've done recently.
Yes, the study, which was a book about the degree to which EU member states conceal the total amount of their debts. It's the concealment occurs because their statistical organization, Eurostat, measures direct government debt, meaning debt of also state agencies, certain regional and municipal governments. But it doesn't capture the debts taken on at the European institutions like the EU itself or the European Stability Mechanism, which are the responsibility of the member states. Now, you look at a Moody's or Standard & Poor's study of the EU and the credit risk of lending to the EU, and it is, the risk is it tracks back onto the member states. But then surely, statistically, Eurostat should show that tracking back, but it doesn't. So you've got a whole load of debts that are missing above the member state level, and then you've got a lot of debts below the member state level, for example, in its central bank. So we've all heard, I think, about the major debts that exist in the Target 2 payment system. Well, those are debts of national central banks, and those are not included in the Eurostat figures, nor the quite large debts of public sector entities that don't count as within general government. Now, those could be development agencies, they could be public utilities, water, transport, and so on. And then you've got a whole load of schemes which, President Macron refers to as creative financing schemes that build up debts, particularly in programs run by the European Investment Bank, where the debt service definitely tracks back onto the public sector, or else the scheme wouldn't fly. But the debts certainly don't appear in any public sector balance sheet. So you've got this enormous extra wodge of debt. And when here in the UK we, have an apoplexy when debt to GDP goes above 100%. Well, in the EU, the debt to GDP is 160% fully loaded, with all the liabilities and missing debts. And part of that is in the financial system. Well, perhaps the knock-on effect for the financial system and the banks is how public sector debt is regarded as risk-free. So, under all these conventions, namely going under the heading of Basel I, Basel II, regulatory capital, how much capital does a bank have to have on its balance sheet for doing this lending or that lending or these derivatives? And the principle is that if it's with a government entity, it doesn't need any capital. So holdings by UK banks of gilt-edged securities, UK government debt, are weighted, risk-weighted 0%. Now, that doesn't mean you can't lose money on if the interest rates go up, the price goes down. but on terms of credit risk, you can't lose. That's a principle because UK government bonds in pounds are central bank money, genuine central bank money. Now, you've got several problems with the euro. Firstly, they haven't got any genuine central bank money because there is no one sovereign entity sitting behind the euro like the Germany or France. This is a sort of synthetic currency in the euro where it's different forms of what they call central bank money, which is government bonds, note and coin, and balances sitting in central banks. Each one carries a different credit risk. Supposedly, really up until June this year, it carried the credit risk of whose name was on it. So if you bought a bond of the Bank of the Republic of Italy, you've bought into a triple B credit. If you buy Germany, it's triple A. If you hold note and coin, it's the liability of the European Central Bank. If you have, as one member of the central banking system, say if you were the National Bank of Belgium, and you've got a balance in the Slovenian National Bank, well, your credit risk is the Slovenian National Bank. You know, each one is different. So it doesn't have genuine central bank money. Now, that may seem very technical. What it means is you've got perhaps as many as 60, 50, no, perhaps 45 or something different forms of central bank money. Whereas in pounds or dollars, let's think about dollars, there's actually 3 which are one. So the note and coin, US government bonds or bills, and a deposit in the Federal Reserve. And they are 3, but they're 1 because they're fully fungible with one another. You can exchange each for the other at full face value, except for any change in interest rates. So, you know, the government bonds or bills, their price is not always 100 cents on the dollar because of changes in interest rates. But otherwise, the 3 forms are fully fungible where they aren't in euro at all.
Okay, well, let me jump in here because what you say about the relative complexities of the euro area, the euro system, it seems to me that that's a key distinguishing element. It's not as if, you know, everything is all and good in any country with a large debt burden and potentially large imbalances, be it the UK or the US. But in a way, at least those entities, it's a little bit easier to wrap around what it is you're dealing with. Whereas in the euro area, it seems that this additional complexity of multiple sovereign borrowers, multiple sub-sovereign borrowers, and the nature of the central bank being a multinational central bank, as it were, and the Target 2 system that, well, in a way, accounts for all those internal cross-border imbalances, does that lend itself to being abused? Is that part of what you're getting at here? That is, the ways in which regulatory capital are or are not properly calculated are simply, there's just more ways to game the system, if you want to sort of put it that way.
Absolutely, and it's being gamed particularly at the government level. You know, the member state governments, they're under pressure to restrain the increase in their own borrowings, but that's easy if they've got all these conduits where they can add debt, which is spent in the economy. So that debt is raised, it's spent on something. That boosts GDP. But the debt just disappears into the ether as far as their debt to their individual national debt to GDP is not altered. In fact, it's improved because GDP goes up when they spend this extra money, but the debt doesn't. So their debt to GDP ratio is falsely reduced. Then when you come to the commercial banking system that is encouraged, and when I say encouraged, it's because the European banking authorities and the local regulators, they all sign off these computations of regulatory capital, on which certain assets and derivatives have a risk weighting of naught, meaning you need no capital at all. And then the bank doesn't need capital. They don't need any margin. They can lend at extremely fine margins to these public entities. And that's wonderful for the public sector as well. But it all starts to fall to pieces when you examine the complexity of the system, and that it actually isn't all the same. And that, in fact, no euro asset should be 0% risk weighted, because it isn't. There are no genuine central bank money assets in euro. This is what made the downgrade by Fitch ratings of the US so outrageous, because the US does have genuine central bank money. This is a colossal difference between inherent creditworthiness of a genuine sovereign state like Switzerland, US, Japan, UK, and a euro member, and in even a Sweden or a Denmark, who would kind of have this sham not being part of the euro. There's a colossal inherent difference. And so if the US had to be downgraded, why does France, Germany, the rest of them not get downgraded? I mean, this is really incredible. And when I mentioned that there'd been a watershed in June, it wasn't the downgrade of the US. It was the non-downgrade of France by Standard & Poor's. And the legitimization for that, having gone through all this analysis on France and concluded it should be downgraded, oh no, we're not going to, because of the implicit support of Germany. Well, where's that then? Where's the support level? Where is it written down?
Isn't that part of the problem, though? Not just between France and Germany, but again, the entire relationship between sovereigns, sub-sovereigns, and banks. It seems that so many of these liabilities, they're contingent in some way. That is, they have some sort of guarantee, which is either explicit or just assumed, as maybe S&P concluded when they chose not to downgrade France. But just because a liability is contingent doesn't mean it doesn't exist. Just because a guarantee is assumed doesn't mean that it necessarily is a guarantee in all situations. How does one even begin to come to terms with that? Because this gray area is so vast. Doesn't it belie any attempt at precise measurement? And doesn't it just lead one to sort of throw your hands up and try to deny that a problem even exists?
Well, I think that's the view of the European authorities. On the other hand, yes, I did try through my book, through the Bruges Group, to at least put a frame around the whole thing, and to admit there are some areas, a couple of areas, where it's not possible to get any real figures at all. But, for example, you have the European Stability Mechanism. Now, the Eurozone member states have guaranteed the debts of this ESM through a common mechanism, which is they've subscribed capital to the ESM but only paid in part. So the balance, which is most of it, is an unconditional, irrevocable liability, and there are real debts outstanding against that. So it's not as if, you've issued a guarantee and the chances of the guarantee conditions materializing is very low. For example, if a ship sinks on its way between Shanghai and Rotterdam, in this case, the debts really exist. They really are guaranteed by the member states, but they're not in the accounting. And that, I think, was something like the total of those guarantees, that amount, where real debts existed, which were not accounted for, was 40% of GDP. And then you had another 24% where there was what I'd call a genuine contingent liability. The debt or the loss didn't necessarily exist. So that's the difference. In one category, the debts really do exist, and in the other, a loss or a debt doesn't necessarily exist, and in the latter category would fit something like the Eurozone equivalent of these huge losses that the Bank of England is now passing to the Treasury on its losses by liquidating quantitative easing. Now, the Eurozone is incurring the same types of losses, maybe not the same scale, but the German Federal Audit Office has warned that the Bundesbank would go bankrupt and need recapitalizing if a substantial loss was booked on liquidating what had been bought. But what was remarkable about that was that they only concentrated on the bonds that Germany had bought itself, which actually wasn't that much of a proportion, because the total portfolio of the Euro system is much, much larger and concentrated in Southern Europe. And according to the rules of the Euro system, any loss is shared around. So if Italy made a loss, Germany would pick up part of that as well as its own loss. So even the German Federal Audit Office didn't seem to understand the way the losses would be shared around. So when you have that, and of course, the ECB, the European Central Bank, is not going to put them right. It says, oh no, Germany, you could lose much more than that. That's the last thing they're going to do. They're going to be laughing up their sleeve. Oh, they don't seem to understand how deep behind.
It's as if they want to have their cake and eat it too. That is, all of Europe, or the Euro area, I should say, wants to benefit from this either implicit or explicit guarantee that Germany has effectively offered through this backstop as part of its obvious role in the Euro system, and yet Germany doesn't want to account for that when it. Well, and so it ends up being this strange sort of smoke and mirrors game where everyone just assumes that, oh, Germany has our back, but they don't actually look at Germany's true implied financial burden that is incurred by having your back.
Yes,
but as a practical matter, if this is a smoke and mirrors accounting game, as a practical matter, what does it mean? Does it mean the euro economy is more severely indebted than we see? Does it mean that capital is being more misallocated than we see? Is there a zombification of the financial system and perhaps of the corporate sector more generally taking place here that isn't properly seen? As a practical matter, what does it mean? And does the substantial rise in interest rates that we've now seen over the past couple of years, is that going to expose any of this?
Well, I think I'd answer your questions as yes, 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 and yes. The total liabilities are much higher than are appreciated because of these shadow debts and liabilities. That has it all been taken on at low fixed rates? Impossible. The rise in interest rates is going to have some effect. If it has been taken on at fixed rates through bonds, then whoever's bought those bonds is looking at a very large mark-to-market loss. How does that affect them? They'd have to get more capital to set against that. The zombification, I think this is what's worrying, is that such a large portion of economic activity is being directed, is being mediated through the public sector. What does that say for the private sector? And I think we have the similar problem in the UK. How much of the private sector is actually government-based work being done under some privately owned entity merely to keep it out of the public sector figures? Well, it's substantial in the UK. I think it's very large indeed. And if you were a private sector entity, say in anything like the energy sector, wouldn't you pile in to green energy with the government behind it, low risk, high returns? That causes misallocation. I think that misallocation is extremely large. And what happens to the economy as a whole? Well, and I'm as guilty as this, as others, I thought the euro would blow up. And when it didn't, I suppose I hadn't realized until the pandemic the degree to which the European authorities were prepared to break their own rules to create another bond buying program, ditching the rules that had applied to the previous ones. That's the pandemic emergency purchase program. Then they create the coronavirus recovery fund, hugely increasing the debt raised to the European Union legal entity in defiance of treaties. I mean, these safeguards were just melted. So it turned out that what I thought would create a crisis could be circumvented by yet more of the same without any of the treaties and safeguards kicking in at all. Those were just melted. But that's fine for a while, but what happens in the longer term? And I think undoubtedly this debt level and the debt cost will be deflationary. And rather than the Eurozone blowing up like it in some conflagration, I think there'll just be increased stagnation. And I suppose, in my view, we're already seeing that. So the burden of the extra debt and the debt cost. So if you have a green energy project, that's Keynesian counter-cyclical public spending. Well, yes and no, it is. But it isn't if you're just replacing a coal-fired power station. So the generation capacity is the same. You're just replacing it. Now, that's not Keynesian economics. Keynesian economics is to create new capacity. Replacement capacity doesn't count. And if that coal-fired power station was written off, its capital cost was written off, well, the green one, financed through InvestEU, the capital cost of that lasts 30 or 40 years. And with the expansion of that, no new capacity, that has to be deflationary in the medium term. Okay, when it's being built, it's inflationary because the debt is spent on kit, wages. That puts money into the economy. But then in the medium term, it has to take money out.
But that sort of deflationary pressure presumably is simply going to be countered by the European Central Bank, which will continue to expand the monetary base through whatever policy means in order to prevent those natural deflationary or don't get me wrong, unnatural deflationary forces, but deflationary forces that are circulating and existing within the economy, to prevent them from resulting in an outright contraction of the money supply, to prevent them resulting in an outright appreciation of the euro versus other currencies. And this has been going on for a long time. That is, there's been tremendous efforts by the ECB already to prevent any of these legacy issues becoming outright deflationary. So, I mean, what's to stop this just continuing on as it's been going indefinitely?
Well, I suppose, firstly, they seem to have changed their mind, and it's because the US has changed their mind. It's turned into inflation. We've had to have higher interest rates, and those are going to persist for a considerable period of time. Then the money supply in the Eurozone is actually reducing. Not by much. I mean, Christine Lagarde made a speech at the central bankers' jolly in Jackson Hole. I think it was yesterday or the day before. The money supply, M3, is actually falling. And the mood music is completely different. It's set by Jerome Powell. In a way, the Eurozone authorities has the same problem as the Bank of England. They're a tracker fund of the Fed now. Because of what they did before or didn't do, they have to jump to Jerome Powell's tune, and they will do. And then that increases the burden of the debt, because if interest rates were 1% or below, this is not a burden. If they cost 3-4%, that is a burden. That simply sucks money out of the economy. But one of the key things is when the international investors wake up and realize what they're putting their money into. That means, when do the rating agencies wake up? Or are they so in the thrall of the EU that they can't wake up? I mean, this was what was so surprising about Fitch and the US, but not about Standard & Poor's and France. You know, they sing the EU tune. Now that's fine, and all the bandwagon can go along. But in a way, the longer it goes on, the worse it is. Because if you try to break out of stagnation, you have to start breaking out now, right now. The minute you realize it, you have to do things to break out. But if you are covered in a stagnation-inducing comfort blanket, like the ECB, maybe it's years before you even realize you have to do anything. And then it takes 30 or 40 years more to get out of it. Well, that's, in a way, that's what I think is going to happen. 30, 40 years.
That's generational. I mean, you're talking about a lost generation in Europe. And again, all of these trends were well entrenched long before the breakout of war in Ukraine, which is clearly making a bad situation worse, in which obviously Europe is the front line, as it were, in that tragedy. It just seems to me that as you say, Europe needs to break out. The euro area needs to break out, but through accounting shenanigans and whatever else, they don't feel compelled to do so. I mean, again, if it's just going to lead to a lost generation and a prolonged stagnation, that's terribly unfortunate for the young and old alike, I suppose. But what is an investor to do? Are there any practical takeaways if we want to try and make some sense of this, looking from the outside in? What's an investor to do? Are there any practical takeaways here?
It's very difficult, isn't it? Because if everybody else believes the story that everything's fine, it's hugely difficult to break ranks. And one thing that's very, very difficult is to short sell any of these bonds, because that's been rendered.
It's not a free market, is it? I mean, there's nothing like a free market.
No. You can't take a big bet against the authorities. Firstly, they'll see, because they see all your activity, surveillance. And secondly, they will punish you. So that means if you don't like what's going on, you have to get out. Now, that's very brave for a global investor to say, I'm not holding any Eurozone investments at all. I can't really give an answer there. But I think actually, when you say a lost generation, youth has already been thrown under the bus. It's 20% youth unemployment. What does that say? That's scandalous. But that doesn't register at all, apparently. That's not regarded as a problem at all. I mean, that's a horrendous problem. So I think what you have is these EU authorities, they're so divorced from what's actually going on. And then, shutting down farms. I mean, for heaven's sake, we need to eat, don't we? This is, in my view, an extreme version of the dislocation between the governing and the governed. And it's in the interests of the governing that this whole thing goes on. And what happens then is Ukraine is seized on, not as an opportunity to change course, but as a excuse to do more of what you already wanted to do, or to delay stopping it. That's how the pandemic was used, an acceleration of what the authorities wanted to do. So actually, the problem then is every crisis accelerates rather than is writing on the wall. And so the next thing is, what are they going to do about China? Because China's incredibly important to the EU, the Eurozone, as an export and import. Is that the next crisis in response to which they have to start bond buying again, bring down interest rates?
Well,
and then if international investors looking at that, what are they going to think? Are they not, a few of them, gradually thinking, this is ridiculous? When's it going to stop? And then they have to look at the US and see what's happening there. And they won't change course. Jerome Powell won't change course. And then you finally get the divergence of central bank policy. And how will investors look at that?
Interesting, because you're absolutely right. There's been a huge convergence in central bank policy for years now.
Yeah.
There was general agreement that easy money was if not the solution, at least the necessary response to what happened in 2008 and 9. And then, of course, many years later, the pandemic hits and you get all these negative supply shocks as a result of lockdowns and whatnot. Inflation surges. And then finally, of course, well behind the curve as always, central banks finally start acting. But they act more or less in concert. I mean, the Fed might have been in the lead, but clearly it acting more or less in concert. But you're suggesting now that there might be, looking forward, some divergence building up, which historically, of course, has led to exchange rate volatility and has led to dislocations as a result of that, some of which could be political in nature when it gets severe enough. Currency crises frequently have political consequences. And you are suggesting that the only way out for the euro area is ultimately going to be some sort of political way out. That is, there's no accounting or economic necessity that will require or result in, I should say, a change of course. But then that means that if change is going to happen at all, it's going to happen at the balance box. Is that right?
Well, I think you've got it could happen in many ways, and it's so difficult to predict. The governing class is perfectly happy with the way things are going. Now, how do they get unsettled? Well, if they have so many levers of power to print more money to keep their show on the road, that's what they'll do. Over years, decades. I think actually if you ask European politicians, how do you view the economic difficulties in China? They'd say, it's very serious, very concerning for us. Ask US politicians, they say, it's good. Our main geopolitical rival hitting the buffers, that's good. And there you have the difference. US politicians would see a downturn, a significant bloodbath in China is really good news, and the Europeans would think it was a disaster. There you have it. That's the root of a divergence, possible divergence.
Right. Well, I mean, it's certainly challenging times all around. But the euro area, as you say, the challenges in many cases are more opaque and they're more complicated, both on the financial, economic side and the political side as a result of the multinational nature and structure of the entire euro system and euro currency. So yes, very hard to know where we're going, but it's certainly much better to have some sort of framework in place for understanding or trying to understand and try to come to grips with and grapple with what exactly is going on. So as always, Bob, your input is very, very much appreciated. If our viewers would like to learn a little more about your work or find your work, is there any place that they could go?
Well, my own website, really. It's all in there, lyddonconsulting.com.
Okay, fantastic. Well,
full inventory under the blog.
Okay.
It's all there under the blog, one way or another.
Okay, great. Well, thank you very much for your time, and I'm sure we'll want to have another catch-up chat at some point in future. Thank you.
Thank you very much, John. Much appreciated. Bye-bye now.